Again, good morning, everyone. I hope everyone had a fantastic weekend. Happy Father's Day to all the dads out there as well. Me being a new father, I enjoyed it, and it was good to see a little rain as well. My grass is a little bit greener today as opposed to the yellow that we've been seeing. My name is Sam. I work as one of our advisors here on staff. Joe is going to be out this week. He is on a business trip, but he should be back with us next week here. Topic today, something that I think has been in the news here quite a bit. We're going to be looking at two things. It's going to be higher taxes and rising inflation, how they can be a lethal combination for your retirement. That being said, we do have to run through something the attorneys make us say here. But we're not tax advisors. We can't give any sort of legal advice. We're not attorneys. We're financial advisors. So we specialize in retirement planning and investment advice. So with that being said, we'll jump right into it. So our first slide here, we are looking at, again, rising inflation, something that if you've been watching the news recently, CNBC, things like that, it's starting to pop up quite a bit more. The basic definition of inflation is it's the rising cost of goods over time. So again, as prices continue to rise, it erodes our purchasing power or how far our money is going to go for us. I think we've seen this pretty recently too. You go to the gas pump, you go to just going down the street and looking at home prices, the price of lumber, things are starting to go up. Morningstar, I saw a recent report last week. And if you listen to our radio show, we talked a little bit about this Saturday morning as well. But they did a survey here recently, and they went all the way back to the year 2000. And they looked at Social Security and found that there was a 33% loss in folks' buying power since then. They're looking at things that a lot of seniors are spending money on, right? Prescription drugs, housing, health insurance, food, various taxes. So it shows you the power that inflation has over time. If you saw the Fed, they came out, last week, Jerome Powell, they came out with the minutes on Wednesday. They're now targeting 2 interest rate hikes here as soon as 2023. We've been kind of told that over the last couple of years, inflation is going to be rising at some point. We've kind of been pushing it out, trying to get outside of COVID and the stimulus here. But inflation rates are going to be going up. Again, the graph on the slide here, even recently, like we said, we've seen this already at the gas pumps, lumber prices. If you're buying a house or even selling a house, the housing market is going through the roof. My wife and I were looking at getting a 3-seat SUV. Right? We need 3 rows, our growing family. And the price for a used car is almost as much as buying new. And the biggest reason for that is, new cars even, some of them are months out. This graph here is showing what inflation rates have just done year to date. Respectively, we started off January here, we were floating around 1.4. February is at 1.7, March 2.6, April 4.2, and as of May, as recently as last month, we were already up to 5%. So we're seeing this already happen sooner than I think what a lot of people expected. And really, this is kind of a reason we're seeing this is the economy is starting to open up. If you've been going out maybe to restaurants or whatnot, Twins games, whatever it may be over the last couple weeks, it seems like things are starting to open up a little bit more here. So with that being said, the demand for goods is exceeding the short supply that we have. We've been closed down the last 12 to 16 months. Prices are going to be starting to rise here. So the biggest thing that we want to look at are, what can you do? What are some strategies that we can look at to try and combat, the rising inflation, looking at taxes, things like that. Harry Markowitz, the famous economist, he came up with this modern portfolio theory back in the 50s. He won a Nobel Peace Prize for it. Essentially came out and said that, historically looking at what the markets have done and the risk, the rates of return, that we should have in retirement around a 60-40 mix, right? 60% stocks, 40% bonds. 20, 30 years ago, that held true. The bottom line is it's probably not that simple today. We've seen a decreasing interest rates. Pretty much going back to the 70s or 80s. A couple months ago, we were at all-time lows for interest rates, and this interest rate curve is going to start rising for us. And as we know, as rates increase, bond prices will decrease. So it's going to be tougher and tougher for us to get a better rate of return for safe money. That 40% that Harry Markowitz was saying. So we need to be looking at some bond alternatives, some things that can still give us a safe return, but hopefully a little bit higher than what our CDs or bonds might be paying with this rising interest rate environment. We look at the 60%, the stock portfolios. It's a different ballgame now in the markets. We've got Robinhood accounts. We've got these cryptocurrencies, Bitcoin that you're hearing a lot about, GameStop, things like that are just sending the markets into turmoil in the short term. For the most part, over the last 12 to 13 years, going back to 2008, 2009, the markets have, for the most part, trended upwards. They've done really well performance-wise. What'll happen, though, if we have another 2008, 2009? We have another COVID, something like that, where we have a prolonged market downturn. If stocks are getting beat up and we know that yields on bonds aren't paying as much, we've got to find some ways to try and get a rate of return to ultimately make sure that this money that you guys have saved up and worked so hard to save, that it's going to be there for the rest of your life. So really in today's environment, it's not as simple as just doing a 60-40 mix and hoping for the best. We've got to be putting a plan together. And that really just goes back to what we do here at Secured Retirements. It's putting together a plan in place to make sure that first and foremost, you've got an income that's going to last you a lifetime. Secondly, if we can morally, legally, ethically help you to reduce taxes, pay less to Uncle Sam, let's look at some strategies to do that. The third thing we'll look at is let's try and grow your wealth, but not at the expense of the first two. So, again, what we do here, it's more than just looking at the investment portfolios. Another big thing we're going to see here, and if you've, again, been following us for a while, this is always a hot topic button for us, but higher taxes, right? And how this could potentially crush or impact your IRA and 401k dollars. These monies that have been saved up tax deferred. Most of us here, I think, have the majority of our savings in our 401k plans through our employers, or maybe we've rolled them over to IRAs in the past. But they're these tax deferred funds that, for the most part, right, we've got a silent partner in these accounts, and that's Uncle Sam. It's the IRS. Ultimately, Washington, the IRS, in their infinite wisdom, right, they get to determine how much or what percentage they're going to take out of these accounts. I read a nationwide here survey last week, and they said 57%, so over half of Americans don't consider or plan around how much they're going to be paying for taxes. And that was, to me, it was an astounding number. Over half of the individuals out there aren't looking at the tax implications. We're at 40, 50-year lows for tax rates, right? Taxes are on sale as it currently stands. We just pumped close to $6 trillion into the national deficit here for COVID, the stimulus over the last 12 to 16 months. There's talks of another $2 to $4 trillion for the infrastructure bill. That was on top of the already ballooning debt. We've got Social Security, Medicare, Medicaid, 10,000 baby boomers retiring per day. We got to start finding a way to start, again, paying for all this money that we're pumping into the economy. As we were saying, tax rates are at a 40 to 50-year low. We need to take advantage of tax rates and how they're on sale right now. And that's really utilizing an advisor that looks at tax planning. When we talk about tax planning here at Secured Retirements, it's different than tax preparation, right? So tax preparation is going to be, for the most part, working with your CPA, your tax advisor. Maybe you're doing TurboTax and self-preparing, but it's going through the 1040 and, for the most part, the W-2, and it's looking at wages that have already hit the return. So it's doing some reactive planning. Tax planning, what we do here at Secured Retirements, it's looking at a macroeconomic view. So how over the next 5 years, 10 years, 15 years, 20 plus years, with the current tax rate environments that we're in, how can we help you guys pay less to Uncle Sam, whether it's meant for you or maybe the kids later on down the line? It's looking at things such as Roth conversions, getting the money into a tax-free bucket where if we need to take the money out at a future date, we're not going to have the tax implications of doing so. We talked about that Morningstar report earlier on, that 33% reduction in purchasing or buying power. Social Security in and of itself, if that was the only income that we had coming in, the only thing that we could live off of, it'd be a completely tax-free asset. We'd never have to file another tax return again. But it's when we start adding other income into the picture, whether it's wages, whether it's pensions, or potentially those RMDs, those required minimum distributions that we have to take out of our accounts here at 72, the 401ks and the IRAs, that's where it starts to create some additional taxation around the Social Security benefits. When we're looking at Social Security, right, just the taxes, we're looking at that loss of purchasing power. This money's not going as far as it used to. So it really goes back to, again, working with someone that is looking at the entire picture, not just looking at the investments, but looking at the income planning, the taxes. The investments are important as well, but we got to be looking holistically. So you want to be working with someone that is, again, looking out for the old picture. The old adage is, right, the best time to plant a tree is to do that today. And that is essentially what we're offering here at Secured Retirements. It's sitting down with one of our advisors, one of our team members, and at the very least having a discussion. Whether you're a current client of ours that we've already gone through this process and we just need a review, or if you're a newer client, first time ever coming onto one of these, schedule some time with us. We'd love to sit down with you and just have a discussion. Make sure that the plan is working for you. You can email us here at info@securedretirements.com or call the office here at 952-460-3260. Again, 952-460-3260. We would love to chat with you guys and see how we can help. With that being said, if we do have any questions, I think I got one here from Kurt. Kurt, what taxes do you see going up before 2026? That is a great question, probably a loaded question as well. Recently, obviously, we've got a transition with a new party coming in here as of January. We've already seen some headway coming down the line with capital gains taxes, right? We've seen some of those higher income earners, if you're making over $1 million, capital gains rates going up to over 43%. That's one thing that we see potentially going up sooner than 2026. We look at that, the step up in basis, right? If this money is maybe going to the kids or the grandchildren someday, they may not get that step up in basis at death. Higher Medicare premiums, that's a big one that's been on our radar for quite some time. You get penalized if you make over a certain amount. So we want to make sure that we're looking at those limits. Tax rates in and of themselves, that potentially could go up sooner than 2026. I think it'd take quite a bit of work legislatively to see that happen before then. Social Security, that's another one that's kind of been thrown around there as well. At most, as it stands in today's code, we can get taxed on 85% of our Social Security benefit. There could be talks of that going up to 90 or even 100%. So there's a lot of hidden taxes out there that before even tax rates go up starting in 2026, which is when they're set to expire, that we could see coming down the pipeline. There's been some talks of even retroactively having it happen as soon as 2021 this year. I think that would be a tough sell. We're still getting out of, the pandemic, the COVID and things like that. But we could see potentially some higher taxes coming up here, maybe even as soon as next year. So it just goes back to, again, we got to make sure that we're getting ahead of this. It's really about making sure that we have a plan around inflation, taxes, having an income plan. The investments are important as well, but we got to be looking at everything built into one, that holistic plan. With that being said, I don't think we have any other questions that I can see here today. Like I said, you guys want to sit down and have a chat with one of our advisors, send us an email, give us a call. We're available here. And outside of that, I hope everyone has a fantastic upcoming week, and get out there and enjoy the nice weather. Take care.